Welcome to Heller-Hurwicz Office Hours, the podcast where we feature University of Minnesota economists and the research that helps us make sense of a complex world. In this fourth season, we are continuing our deep dive into how rigorous economic research informs our understanding of the rapidly shifting global landscape. In April 2025, President Trump announced a paradigm shift in American trade policy. By imposing broad, aggressive tariffs, the administration aimed to slash trade deficits and spark a domestic manufacturing renaissance. At the same time, many economists warned of disaster. So fast forward to today. The journey has been anything but linear, marked by constant shifts in the administration's strategy and the Supreme Court's recent landmark ruling that the emergency tariffs were unconstitutional. Now, more than a year into this experiment, the data is finally starting to tell a story. So to help us read between the lines, we are joined by economists Tim Kehoe and Mike Waugh. Well, welcome, and I'm glad you can make sense of all this for us.
Well, we're going to try, Chris.
All right. So remember Liberation Day, April 2025, and a lot of economists, maybe most economists, were really concerned about how these high tariff rates would have a negative impact on the economy, not just the U.S. economy, but also the global economy. Now, looking back over the past year, the economy is still growing. We're still expanding. So what has been the impact of these high tariffs? Start right out with you, Mike.
Yeah, it, so I first got to give the usual disclaimer that anything I say are my views and not the views of the Minneapolis Fed or the Federal Reserve System. I think when we think about Liberation Day, I'm going to give you a kind of alternative take on this, is that um, yes, there was a bunch of doom and gloom provided by economists, and I think you can see things that like the Minneapolis Fed has posted that I have said. Um, but one of the things that I think we understated was how strong the boom in AI and the AI data center build out has shaped the US economy. And so the one way to think about this is that, we have this like strong underlying trend going on in the US economy right now, and it's basically masked any potential negative effects of the tariffs. So a simple way to think about this is you look at trade volumes. So if you looked at 2025 US trade volumes, they basically hasn't fallen, right? We increased tariffs by, I don't know, 10 percentage points, 12 percentage points, yet trade hasn't fallen. How can that be? Well, once you go under the hood, you see this massive expansion in trade and AI related products. And then once you strip that out, you start to see trade did fall. Fell in a way that looks very much consistent with like economist predictions. So I think like that's an important element when we kind of do a retrospective on 2025 and the Liberation Day tariffs, is that, we weren't thinking just like, I don't think even today, I don't think we still understand how transformative the AI data center build out is right now to the US economy.
And Tim?
Well, I agree with what Mike just said, and I am going to try to say a couple different things, because a lot of what I'm thinking about tariffs, I form my views after conversations with Mike. But here's a couple things to remember. The tariffs that President Trump put on TV on Liberation Day were largely not enacted, so that the very, very high tariffs on some countries just never came into effect. And there were various reasons for that, and I'll mention a couple of them. But first, let's get to the doom and gloom. And you'll remember, Chris, that when I talked to you last year at about this time with Chris Farrell, who is now on leave from our economics department as the head of the president's Council of Economic Advisors. But when I talked to you, I thought this was going to have a really negative effect on the U.S. automobile industry, because our automobile industry is so integrated with Canada and Mexico. In fact, It's not fair to call it the U.S. automobile industry. We'd call it the North American automobile industry. And you know what? That the U.S. automobile industry is not doing great, but it's not been the doom and gloom that I predicted. So I'm like Mike. I'm taking some responsibility for what I said, and part of the reason, and Mike shared an article with me, and also the results of some of his own research. Let's think what a lot of the trade is. It's between Ford, GM, Dodge, trucks, so forth, in the United States with their subsidiaries in Canada and Mexico. And so when there's a change in tariffs, the companies can just react by changing the prices they charge each other. If there's a big tariff on Mexican automotive components, or even the finished automobiles, what they can do is just lower their price. This is something called transfer pricing. It's a common practice in accounting, and there's people who are experts on it. Now, it's often done to lower income taxes paid. So there's many years that the Minnesota's biggest export target is the Republic of Ireland. And that's because high-tech companies here, 3M, Medtronic, they ship equipment to the Republic of Ireland for which they charge the Republic of Ireland a very low, their wholly owned subsidiary in the Republic of Ireland, a low price. And what that does is it moves all the profits from that activity to the Republic of Ireland. Then the good is processed further. It has to be to escape tariffs. It's processed further and shipped all over the EU. Why do we want to put all the profits in the Republic of Ireland if we're 3M? It's because there's all kinds of tax breaks on the corporate taxes. The same thing works for tariffs. If you got to pay a lot of tariffs, just charge a very low price, ship the profits to a wholly owned subsidiary, or keep it in the home country. For these automobile countries, companies, a lot of their profits end up in a tax haven anyway. And there's ways that that's done. You sell the patents for research activity to Ford in Bermuda. And then that's who the Mexican Ford company pays for using developments in Detroit.
Yeah.
This is all within the law. It's all done within the law, but companies now are good at doing that. So that's why we haven't had some of the doom and gloom.
And Mike, is that one of the things that comes out of this period, a deeper appreciation of how, I don't know, resilient, supple, flexible are these global supply chains?
Yeah, I think like one of the lessons from the COVID pandemic is that the companies really thought through very carefully about their supply chains and about the way they handled it. And so right now, I mean, it's almost like you think about like soldiers, right? You went through one war and then you face another war, and guess what? You have a bunch of experience. Or like, I don't know, I was listening to Timberwolves last night, and they're talking about the Timberwolves have all this experience, and the San Antonio doesn't have any experience, right?
Yeah.
Same thing with these companies. They've been through it all. And, when the tariffs hit, they have a lot of levers to pull, and they're used to pulling those levers. So Tim brought up transfer pricing. That's certainly one of them. Another one was inventories. So if you look at the trade data again, in the first couple months of 2025, there was a massive surge in imports. And that was just firms accumulating inventories to ride the wave. And And so I think we're kind of, yeah, like you said, is these companies are a bit more flexible and nimble than they were in the past, and they've learned their lessons. Whether it's COVID or even you can go back further, the first Trump tariffs in 2018.
And I was curious, Mike, when you were talking earlier about the impact of AI, all that massive investment, and we also though have no real decrease in trade volumes. Is part of that a lot of this AI investment, I mean, yes, when you're building the data centers, that's being done here, but what's going into those data centers, isn't a lot of that imported?
Yeah, exactly. So when you think about a data center, like what's going, the obvious thing is like GPUs and microchips and stuff like that, and memory, and that's coming from largely Taiwan. Um, but there's all these other components like cooling, HVAC, electrical stuff, and so that's surging as well. So it's like a broad array of products that are coming in. And kind of the interesting thing, I mean, this is related to research I've been doing, is the second biggest uh, source for AI related products is actually Mexico. So what's happening is we're bringing in a lot of like either like processed chips and like various like whatever they call them, like server kind of stuff, or it's like other related components are coming through Mexico. And then the third thing I'll add about this is that also, and this goes back to what Tim was saying about when President Trump stood there on the in the Rose Garden with that kind of like poster board with all those big numbers and stuff,
Yeah.
it looked really scary. But very quickly after that, they released a list of products with exemptions. And so they exempted a very wide swath of products. And when you kind of look through those exemptions, it's big, it covers a lot of stuff. And C or B, it actually covers a lot of things that were related to like this AI data center build out. So tons of electronics, um, related kind of components were not covered by those tariffs. And so again, it's like what Tim is saying is I think, we look at that poster board, we all got really scared, and then the more you start thinking through the details of it, it didn't turn out as bad as we may have thought.
Well, one thing I'm curious about it, I think one of the divides between economists and people who are interested in the economy, but they're not economists, is the trade deficit. I mean, a trade deficit sounds really bad. And the tariffs, one of the major justifications for the tariffs was we are going to close or at least, dramatically narrow that trade deficit. So what does the past year tell us about the trade deficit?
Well, the trade deficit has gone down, but not by any huge amount. But what we have to remember is that whatever we have as a trade deficit ends up being a what we call a surplus on the capital account in the balance of payments. That is, it means that foreigners are investing in the United States. And actually, the investment in the United States has weakened, and that could be a very detrimental effect of all these tariffs and uncertainty about um, tariffs. And if you remember why uh, President Trump called off the Liberation Day tariffs the next week, it was because the U.S. came close to having a failed bond auction for U.S. Treasury bonds. Um, and that's because we depend on foreigners. Uh, we depend on foreigners, and it's been a lot China in recent times. But before that, it was Japan, and Japan still holds a huge stock of U.S. bonds. And if they want to dump those bonds, and that's something that the economists get nervous about. That's going to cause economic instability. High interest, low bond prices translate into high interest rates, and it also, I go to economics conferences in other countries in June, and I'm looking at the value of the dollar, and it's way down this past year. So you see, are some negative consequences to this, and having a low trade deficit usually is a bad sign. It's a sign that the economy is weak and that foreigners don't want to invest here.
And Mike, the other major justification was to revive American manufacturing. You would both provide a shelter for American manufacturers and also an incentive for overseas companies to open up their plants here. Now, with the benefit of hindsight, looking back, I mean, until it does, manufacturing employment has gone down. I mean, what has been the impact on manufacturing, which was the other major justification?
Yeah, I think if you look at manufacturing employment, it's a bit lower than it was. I think the trend is it's hard to tell if this was not a pre-trend from the Biden administration, or it is actually related to the tariffs. But I think employment's lower. Um, my personal opinion is I kind of feel, or my research suggests that, or the body of research out there suggests that um, it's not a good approach to revive U.S. manufacturing. And this actually, Tim, I'll kick it back to Tim, but Tim wrote this really nice paper with some former University of Minnesota grad students, and they were thinking about the U.S. trade deficit, and they're thinking about the U.S. trade position. And they thought about like the usual suspects, but one of the things that they were thinking about, which I think is quite interesting, is structural change. So, what is structural change? We know that as countries grow, there's a systematic shift from agriculture to manufacturing to services. We are the most developed country in the world. This natural shift away from manufacturing is just something that happens. This is the way modern economies evolve. And trying to like fight against it isn't, I think, through tariffs or other kind of policies isn't very viable. Um, so that's why I think if we're looking for like this like big manufacturing boom, tons of employment in manufacturing, we're back making stuff, I'm very skeptical about that. The other thing I'm going to add on this too is we also got to think about how these tariffs are hitting different products. So a huge amount of the products that we import are actually imported intermediates. So those are things that go into and facilitate the production of manufacturing output in the United States. So what did the tariffs do? They raised the cost of those imported intermediates. What does that do? That means these manufacturing firms are going to think about hiring less workers. They're going to produce less stuff given that their inputs are higher. So again, it kind of the way the policy was structured kind of backfired. And and like Kim was talking about like the automakers. I mean, this is exactly their complaint. Is like, hey, yeah, we want to be protected. We don't want to compete against the BMWs of the world, but we also don't want our transmissions coming from Canada to be tariffed. And that's what's happening.
So, Tim, tell us a little bit about your paper.
We looked at, in that paper, we looked at the trend of manufacturing productivity. And what we see is that increases in productivity, that increases by about 4% per year since we're talking about since 1990.
And productivity meaning you're just doing more with less.
You're more with less, and especially more with less labor because there's more and more automation in manufacturing. And that's a trend that started before the big deficits with China. And our deficit with China in particular is way down, and it's still continuing. And that's going to happen no matter what. And the tariffs aren't going to have much effect on that. And that's what that's what Mike is referring to. And thanks for giving that reference, Mike. But the thing is that the decline in manufacturing employment is natural. But you know what's happened with that increase in productivity? The prices of manufactured goods is going way down over time. Not all of them, but I'm sitting in front of a computer now, and if I had tried to buy this computer 20 years ago with the same amount of memory and so forth, it would have been really tough to get. And it it would have cost twice as much in dollars. So there's something good about the increase in manufacturing productivity, but it means we get more stuff for less, and we don't. This is something important about structural change and preferences of consumers as they get richer. They don't want to double the amount of computers they buy. They want to start going out to nice restaurants or getting better haircuts or whatever. So that's the shift into services. Um, and that's going to happen no matter what the tariffs are.
Yeah, and Mike, going back though to the shorter term, I think one of the surprises a lot of us have been dealing with is, at least I expected, I think a lot of people expected that we would see higher prices fairly quickly. And, Tim was mentioning the transfer pricing, but I get the sense that you've had the transfer pricing, you've had the inventory that can be tapped. There's been a lot of strategies over time that slowed the price increases, but my sense is that we're still kind of in an upward trajectory. It's working its way through the system. Now, is that right? Is that wrong? How about the inflationary impact?
Yeah, that's my personal view is that, we're just now starting to see the tariffs impact inflation. And so there's some things that, like with Neil Malhotra and I have on the Minneapolis Fed website. And then when you kind of think through what's happened in 2025, I don't view as inflation of 2025 as actually being driven by tariffs. But the last couple PCE releases is you do definitely see categories where we would expect to see large price jumps. We are starting to see that. And that's related to, I think firms are very hesitant. There's tons of reasons why, but the firms are very hesitant to just like immediately increase their price, whether it's alienating customers or it's, smoothing, again, I think it's a customer relationship kind of story. But, as we go into 2026, we start to see, yeah, they're going to increase the price. I think what's hard to think about actually right now is we haven't talked about 2026 is that, tariffs have come down, right? And then the Supreme Court struck down the Liberation Day tariffs. And now, like I was just looking at this on my website, is like the effective tariff rate in the United States is about 7%. That's almost like, that's lower from a peak tariff rate of like 11% in October 2025. So, there's a sense about, is this actually going to manifest in prices? Are companies going to bite it? I think there's still a lot of uncertainty on this, what the price impact is going to be.
One thing that Mike just said that's important is the biggest problem with the U.S. Tariff policy over the past year is the uncertainty that it's generated. And that is going to have negative impacts because we know that when there's uncertainty, and we've already mentioned, supply chains are going to be international. I mean, that's the world we're living in. And when we have uncertainty about how we want to do our business, big companies want to invest, that is one of the big negative impacts of the tariff policy. It's the uncertainty that it's generating for firms.
I think, yeah, and Mike, just last question. There's been this strand of commentary. I'm sure you know about it, but you read it sometimes in commentators in Financial Times and other publications that this experience shows that the economist business model is broken. That you're not really able to capture what's going on, and so I'm curious what your reaction is to that. I mean, well, no one cares what my reaction to it. What is your reaction to it?
I think it's dead wrong.
Yeah.
I joke with my co-authors. I practice faith-based economics, and I'm a strong believer in neoclassical economics and as a framework to be thinking about things. And what we need to realize is that, like I talked about AI. There's always tons of things hitting the economy right now, and that's what makes economics hard. Is like economists look at things in isolation often, but real life economies have multiple things taking place. And I'm not going to go back turn the video off and go back to my office and like completely rethink about how I think about economics based on 2025. And like I said, I'm really, really believe this is I think once you strip out AI stuff, it looks like business as usual.
Yeah. Tim, for saying.
And as you were mentioning, Chris, the U.S. economy is still growing, but at a slower rate than it has been growing since the pandemic. And what was shocking about the U.S. economy in the years immediately after the pandemic and up until last year was how well the labor market was doing. And the labor market's a lot weaker right now. And so economists are getting worried about it, and I think they're right to get worried.
Well, we could keep going. That could start a whole new conversation, but I think this is probably the right point to end our conversation. And thank you very much. This has been absolutely wonderful.
That's great.
No, thank you, Chris.
Tim Kehoe is an economics professor at the University of Minnesota. Micah Waugh is an economist and monetary advisor at the Federal Reserve Bank of Minneapolis. Office Hours is a production of Matriarch Digital Media, hosted by me, Chris Farrell, executive producer, Twyla Dang, producer and editor, Beth Gibbs, music by Bob Bradley. A special thank you to Heller-Hurwicz Hannah Fairman and Janine Sorrell. Subscribe to Heller-Hurwicz Office Hours to hear about the economic research being done at the University of Minnesota. And to learn more about the research we discussed today, visit hhei@umn.edu. Thanks for listening.